Every financial crash looks like chaos. Markets collapse, banks fail, and ordinary people lose everything. But behind every panic, there's a pattern. And behind that pattern, a network, a small circle of institutions, hedge funds, and central banks that don't just survive crashes. They profit from them. While the world panics, they quietly move money, rewrite the rules, and emerge stronger. This is the untold story of the secret network that decides who wins financial crashes. To understand this network, we have to go back to the early 20th century, when the modern financial world was born. In 1907, the U.S. faced a massive banking panic. Markets crashed, deposits vanished, and chaos spread. But while ordinary investors went bankrupt, one man became the system's savior. J.P. Morgan. From his private library, Morgan called the country's top bankers. Together, they decided which banks would fail and which would be rescued. Within days, the crisis was over, and the message was clear. Financial power had gone private. This moment planted the seed for something bigger, a network of elite financiers and central bankers who could move markets with a single decision. 6 years later, that power was formalized with the creation of the Federal Reserve in 1930, a supposedly public institution, but controlled by private banks. From that day forward, crisis management became centralized, and with it, the ability to decide winners and losers in every downturn. After World War II, the financial network expanded beyond borders. In 1944, world leaders met at Bretton Woods, creating the system that tied global currencies to the US dollar. Behind closed doors, the same group of bankers and policymakers established institutions like the International Monetary Fund (IMF) and the World Bank organizations that would later decide which nations were rescued and which were left to collapse. When countries faced debt crises, these institutions stepped in, but their help came with strings attached: privatization, austerity, and foreign influence. Every bailout reshaped global economies, and each one reinforced the same hierarchy of power. This wasn't charity. It was control through credit. When a financial crash begins, most people see panic. The insiders see opportunity. Here's how it works. Central banks flood the system with liquidity, money printed from thin air. Large institutions, closest to those banks, get that money first, before inflation erodes its value. Hedge funds and elite investors use that new money to buy distressed assets, real estate, stocks, even entire companies at a discount. By the time recovery reaches the average person, the network has already consolidated power. This is known as the Cantillon effect, the invisible law of money creation that ensures the rich always recover faster than the poor. And during every crisis, minus 1987, Doismu 2008, and even 2020, the pattern repeats. The 2008 financial crisis exposed the network like never before. Banks had gambled trillions on toxic assets, knowing they were too big to fail. When the crash came, the same institutions that caused the collapse were rescued while millions lost their homes and jobs. The Federal Reserve injected over $16 trillion in emergency loans to global banks. Meanwhile, ordinary citizens got bailouts measured in hundreds of dollars. But here's the real trick. Those bailouts weren't losses. They were investments in the system itself. The crisis became a transfer of power from governments to central banks, from citizens to institutions, and the network's reach grew. Hedge funds merged with investment banks. Central banks coordinated their policies globally. Every time the system failed, it became more centralized and more untouchable. Fast forward to today, the same network operates in a new digital era. Faster, smarter, and harder to trace. Algorithms trade billions in seconds. Private equity firms quietly buy nations' infrastructure, and central banks experiment with digital currencies, programmable money that could control not just what you spend, but how and when you spend it. The same players are still in charge, only now their control is hidden behind screens, data, and AI-driven systems. The next crash won't just be financial, it could redefine ownership itself. Every crash looks like bad luck, but it's really a reset, a chance for the network to rebalance, reprice, and reassert control. They can't stop crashes. They need them. Each one washes away weak players and rewards those who control credit, liquidity, and information. Meanwhile, everyday people are told to trust the same market that's rigged against them. The more debt you take, the more dependent you become. The more dependent you are, the easier you are to control. Take away financial crashes aren't random. There are opportunities for the connected few to consolidate power, take away the central banks and global institutions, coordinate to control liquidity, the real source of power in the modern economy. Takeaway 3. The only way to protect yourself is to understand the system and position yourself outside its debt-based trap. Warning. The next crisis may not be about housing or banks. It may be about currency itself. When money becomes fully digital, control becomes absolute. Call to action. If you found this eye-opening, don't let it end here. Share this video, because the more people understand how this network operates, the less control it has over us.